Welcome to today's Explainer. We are jumping right into the fiscal second quarter 2026 earnings report from Lowe's. Right now, there is this totally fascinating tug of war happening with the company. You've got their long-term growth engines on one side, battling some seriously heavy macroeconomic headwinds on the other. So, we're going to lift the hood on this $121 billion home improvement giant and see what's actually going on in there. Here is exactly how we'll be weighing the good news against the bad today. We'll start with the Q2 earnings breakdown, then check out Wall Street analyst reactions. After that, we'll dive into the bull case for Lowe's, followed by the bear case squeeze. Then we'll look at the Home Depot contrast, and finally wrap up with the final takeaway. All right, let's get into section 1, the Q2 earnings breakdown. We need to establish our baseline facts from that August 19th report. There is a real paradox right out of the gate when you look at these headline numbers. Top-line revenue actually looks great. It's up a solid 8.3% year over year, hitting almost $25.96 billion. But it's still slightly missed the consensus estimate of $26.13 billion. Yet, if you look over at the bottom line, the adjusted earnings per share came in at $4.40, which actually beat the consensus estimate of $4.22. So we immediately have this mixed picture. They slightly missed on sales expectations, but they beat on adjusted profitability. So the crucial point is right here, 0.2%. This tiny number represents Lowe's comparable store sales growth. Now, it is their fifth consecutive quarter of positive comps, which sounds fine on the surface, but it's a significant slowdown. And what's really wild is the volatility hidden inside that 0.2%. In May, comps were down 0.4%. Then in June, they shot up 1.7%. But by July, they dropped right back down to negative 1.2%. A massive part of this whiplash was just due to the timing of the July 4th holiday, which essentially pulled about 75 basis points into June, leaving a pretty big drag in July. Because of that sluggish comparable sales growth, management had to make a tough call. They basically trimmed their full year 2026 outlook down to the very basement of every previously guided range. Sales are now expected right at $92 billion, down from that $92 to $94 billion range. Comparable sales, they're now projected to be completely flat for the year, and adjusted EPS is pegged at $11.75. Moving right along to Section 2, Wall Street analyst reactions. Let's see how the market handled this mixed bag of data. So following the report, shares actually fell about 3.1% in pre-market trading, and analysts got busy slashing their price targets. You had Guggenheim cutting from $300 to $275, Piper Sandler tweaking from $276 to $274, Jefferies dropping to $260, and Mizuho down to $250. However, the overarching sentiment from Wall Street is probably best described as cautiously optimistic. Why? Well, they're really just resetting near-term expectations. If you look closely, firms like Guggenheim and Piper Sandler are still largely maintaining their buy or overweight ratings. The consensus among 35 analysts is still a solid buy, with an average price target that implies roughly 17% upside from where things sit right now. All right, let's shift the energy up a bit for Section 3, the bull case for Lowe's. Here is where we see the long-term growth engines that are currently firing on all cylinders. When you group these massive wins together, the foundation of Lowe's looks incredibly robust. They saw some seriously strong growth from professional customers, especially those small and medium-sized pros. And their digital momentum, it's phenomenal. Online sales were up 15.7% for the quarter. On top of that, their loyalty program, MyLowe's Rewards, officially blew past 30 million members, and those members are shopping more often and spending more money. Plus, let's definitely not forget their status as a true dividend aristocrat. 42 consecutive years of dividend increases. These are the absolute pillars of their total home strategy, which is expected to really accelerate market share heading into 2027. And this brilliantly illustrates their digital prowess, a 3x multiplier. Since its launch, the MyLowe AI tool has handled roughly 25 million customer and associate questions. But here is the real kicker. Online shoppers who actually use this AI tool convert at 3 times the rate of those who don't. That is a massive, tangible competitive advantage in the retail space right now. Okay, bringing the tone back down to reality, let's look at Section 4, the bear case squeeze. We have to weigh those heavy macroeconomic forces squeezing the stock. Remember that impressive 8.3% top-line revenue growth we were celebrating a few minutes ago? Well, it's actually masking a whole lot of flat organic growth. When you strip out the recent acquisitions of Foundation Building Materials and Artisan Design Group, Lowe's organic business grew just 0.2%.
Furthermore, financing those strategic deals has pushed their long-term debt up to $35.2 billion, which is up from $30.5 billion just a year ago.
And the headwinds definitely don't stop there. The central pressure point hurting the bottom line is margin compression. Gross margin fell 77 basis points, and operating margin dropped 81 basis points. The big culprit? Persistent DIY affordability pressure. Discretionary, do-it-yourself spending is incredibly tight right now because of high interest rates and home prices. Throw in a weak residential construction market, and things get tricky. Plus, you know that $4.40 earnings beat we mentioned? That was actually partially inflated by a one-time 11-cent benefit from tariff refunds, which their CFO confirmed is not going to repeat in the second half of the year.
What's really interesting here is how leadership is handling the pressure. Some competitors use their tariff refunds to aggressively slash prices in July on items like grills and patio goods, but CEO Marvin Ellison deliberately avoided matching those imprudent promotions. He views this current competitive pricing landscape as a transitory situation rather than the new normal. So he's actively protecting the brand's long-term pricing power over grabbing a short-term sales spike.
Which brings us to Section 5, the Home Depot contrast. We need the ultimate benchmark to properly contextualize this DIY pinch. Take a look at this divergence. In the exact same quarter, Home Depot posted comparable sales growth of 1.7%, which was their best in 4 years, while Lowe's managed just that tiny 0.2%. This 150 basis point gap is literally the widest divergence between the two retailers we've seen in recent memory. And that's especially crazy considering they posted identical 0.6% comps just 1 quarter prior.
So what explains this sudden, massive gap? It all comes down to customer mix. Lowe suffers from much heavier exposure to the DIY customer, and DIY is exactly where all that macroeconomic pain is concentrated right now. Home Depot, with a different customer mix, enjoyed much broader demand for smaller projects. As a direct result, Lowe's experienced an operating margin compression of about 80 basis points. That is roughly 4 times worse than Home Depot, who only saw a 20 basis point drop. It's the same quarter, same housing market, but completely different results, based purely on who is walking through the front door.
Let's synthesize this whole tug-of-war analysis in Section 6, the final takeaway. To summarize these rapid-fire facts for you, Q2 earnings were entirely mixed. There is a persistent DIY slowdown that is heavily impacting Lowe's compared to Home Depot. But, and this is crucial, their long-term growth engines like the Pro business, the 15% digital growth, and those AI tools, they are working incredibly well. Yes, the margin squeeze is real, but the market largely sees it as a manageable near-term annoyance. Definitely not a thesis breaker. The stock is currently hovering near its 52-week low. It's paying at 2.3% yield, and analysts are projecting about 17% upside. So, I'll leave you with this final, provocative question to consider. Will the structural upgrades of Lowe's total home strategy compound earnings over time? Or will these stubborn, immediate DIY housing trends keep the stock grounded for the foreseeable future? That is the ultimate balance you have to weigh. Thank you so much for learning with me today in this explainer. Keep analyzing, keep learning, and I'll catch you next time.